This is video number 5 of our extended series on the taxation of estates, gifts, and trusts.
Now here's an extended example for you of kind of a commonplace example that you might see in your own practice. Okay, this is an average example where you might have a valuable estate, but not one that's going to be subject to estate tax, but one that might have a long period of administration. Okay. Thomas was unmarried when he died on April 1st, so there's no surviving spouse. This is not going to be easy when this happens and there's no surviving spouse. He died without a will. He is unmarried at the time of his death, so his property will pass to his two heirs, which are his daughters, Samantha and Penny. Samantha is age 24, so she's an adult, but Penny is only age 15, so she's still a minor. Penny is a minor, so Samantha is named as the executor of her father's estate by the courts. Thomas earned $83,000 in wages before his death, so a final tax return is required. A Form 1040 has to be filed for him in the year of his death. Samantha is going to be the one that's responsible for filing it. She's the executor. Thomas isn't doing anything anymore because he's dead. Okay? Okay. Samantha asks her accountant to help her prepare her father's final Form 1040, which will include all the taxable income that Thomas received before his death. The accountant also helps Samantha with the valuation of her father's estate. After determining the fair market value of all of her father's assets, they conclude that Thomas's gross estate is valued at approximately $3,400,000. This is a valuable estate, but since it's less than the estate exclusion amounts, an estate tax return does not have to be filed. So a Form 706 doesn't have to be filed, and his estate is not subject to estate tax. Okay, because $3,400,000, the value of his assets at his death, is less than the estate exclusion amount. So a Form 706 doesn't have to be filed, but the estate does have to go through a period of administration. So the Form 1041 needs to be filed for the estate, and a final Form 1040 has to be filed because he earned $83,000 in wages in the year of his death. So those two returns have to be filed, but the Form 706 doesn't have to be filed. The estate owns rental properties that continue to generate revenue, so a Form 1041 will have to be filed until all of the assets are distributed to Samantha and Penny. Samantha is the executor, so she is responsible for filing and signing any tax returns. Okay, Samantha and Penny are his daughters. They're both beneficiaries of the estate. They're beneficiaries of the estate. They're his only two heirs because he was not married when he died. Samantha is also the executor. So she is going to be the one responsible for signing and filing the returns. She hired an accountant to help her. Okay, she's only 24, so she's young, but she's an adult. She hired an accountant to help her, but the person who's going to be signing the returns is her. She's going to sign her father's return, his final return, because she's the executor of his estate, and she's going to have to file the Form 1041s and sign those too during the period of the estate's administration. Penny is still a child. She's the other daughter. And so she's a beneficiary of the estate, and she's going to get money from the estate, but she's not responsible for doing any of this. Okay, she's not going to be signing anything or filing anything on behalf of her father's estate because she's a child and she's not the executor of the estate, but she's a beneficiary of the estate, so she's going to get money, which means Penny and Samantha are going to be reporting the income from the estate on their own tax returns, on their own Form 1040s. So let me give you a diagram of what the scenario might look like when you have someone like this that passes away. Tom is the deceased. He's the taxpayer. He's the decedent. He passes away, he dies, and then his assets pass to the estate. His assets are rental properties, and then he has $400,000 in cash in the bank. This is just a very simplified example. Generally, there's a mix of different assets, but I feel like it's easier to understand how an estate's administration can drag on when you have something like rental properties, because those renters don't magically disappear, and those rentals are going to continue to generate revenue. When you have an estate that has real property, like rental properties and real property cannot be distributed easily. It doesn't happen overnight. It's not like cash. where you can just distribute cash to a beneficiary. That's easy. Many times when you have assets like real property, you have to go through probate, and it can take months and months and sometimes even years before those properties get distributed to the heirs. And that's especially true if you have a situation where the beneficiaries are minors, or one or some of the beneficiaries are minors. So in this case, there's two beneficiaries. One of the beneficiaries is an adult. That's Samantha, who is one of his children, one of Tom's children. Samantha is an adult, so that's why she gets named as the executor. So she's the executor and a beneficiary, but Penny is a minor. So you can't generally distribute assets to a minor, and many times that will drag on the administration for several years, where the assets will remain with the estate until the minor comes of age. Okay, so Penny is a beneficiary only. She's not the executor, but she's going to receive money as well as assets from the estate eventually once she comes of age. So the tax returns that are required in this scenario are the Form 1040, which is the final tax return for Thomas. And the person who's going to be signing that is Samantha. The Form 1041 for the ongoing income of the estate, the money from the rental properties that's coming in. It gets reported on the Form 1041 after his death. And as long as the estate continues to generate revenue, and as long as these rental properties are not in the names or transferred to the children of Thomas, then the estate continues to exist. So as long as there's income coming into the estate from these rental properties that exceeds more than $600, that's the income tax exemption amount for an estate. We already talked about that earlier, remember? $600. As long as there's more than $600 coming in, then the Form 1041 has to be filed for every single year that these assets are not distributed, because the income has to be reported somewhere. Okay? The Form 706 does not have to be filed for this estate because it's worth only $3,400,000, which is under the estate tax exemption amount, which is $11.7 million for the 2021 tax year. So his estate is not subject to the estate tax, but the income coming into the estate is going to be subject to income tax. As long as the estate continues to generate revenue, there's going to be income tax on that money, and either the estate is going to pay it or the beneficiaries are going to pay it, but not both. So let's talk about the estate and how the money flows through. Tom is out of the picture. He's dead. We're just talking about the estate now. Tom's estate consists of the rental properties as well as the cash in the bank account. Let's say there's nothing else. It's just these two assets, the rental properties and the cash in the bank account. Samantha, as the executor, might get paid executor fees. She probably would be paid executor fees. The executor fees that are paid to Samantha are going to be treated as other income on her Form 1040, because she's going to be paid to deal with this hassle. Because being an executor is a hassle, folks. It's work. She's the one that has to go talk to these renters and say, hey, I'm in charge of, dealing with the estate now. My father passed away. If you need anything, contact me, blah, 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 blah. She's the executor. So she's the one that has to be the go-between between these renters and, the estate while it's continuing its period of administration. She's the one that has to deal with all of this. And she can hire people to help her, which will be paid out of the estate, the money that's coming into the estate. But the more people that she hires to help her, the less money that she's going to have to pass through to her and her sister. So as the executor, she's got to deal with this stuff. So executor fees may be paid to Samantha, and if she does get paid executor fees, they're treated as other income, because presumably she's not a professional executor. She was Tom's kid, and she's an adult, so she was named executor by the courts because of that, which is typically what happens. Okay? So if she gets paid executor fees, then she owes tax on the executor fees. She reports them as other income on her Form 1040, and the executor fees are actually a deduction of the estate. Okay, they're considered administrative costs. Now, the income of the estate, the distributive income of the estate, is reported on the Schedule K1, and she's going to get a Schedule K1, and Penny is going to get a Schedule K1. They're both going to get Schedule K1s. Her Schedule K1 is going to list the distributive income that she receives, okay? And then Penny's Schedule K1 is going to list the distributive income that she receives. Samantha is an executor and a beneficiary, and Penny is a beneficiary only. And when they file their tax returns, Penny's going to have to file a tax return too, even though she's a minor, because she's going to be getting income from the estate, presumably. Both of them have to file income tax returns to report their distributive share of income that they receive from the estate. And it gets reported on Schedule E, page 2. That's where it gets reported. And it's rental income, so it retains its character. So the Form 1041 gets filed for the estate up here. And then Samantha and Penny each get their own Schedule K1. And they use the information on the Schedule K1 to report their distributive share of the income from the estate on their individual Form 1040. There's a spot for it on the Schedule E. Okay, I know that many of you have never looked at that spot because maybe many of you don't have experience with this, but it's on the Schedule E, page 2, and that's where a beneficiary would report distributive income that they receive from an estate. And they pay tax on it, just like Tom would if he was receiving that income himself. But in this case, it's the estate that's earning the income because Tom is gone, but these rental properties don't belong to them yet. They haven't been distributed yet to the beneficiaries, and they probably won't be distributed for several years because Penny is still a minor. So the estate is going to continue its period of administration, maybe until Penny turns 18. And then these rental properties can be distributed to Samantha and Penny both. But until that happens, until these assets are distributed, then the Form 1041 has to be filed. And then the income is going to pass through, that rental income that these rental properties are earning. And presumably Samantha's going to get, 50% of that rental income, and Penny will get the other 50%, and they'll file income tax returns to report it. That's generally how it's done. Let's talk about how you value a gross estate. The gross estate is based on the fair market value of the decedent's property, which is not necessarily equal to its cost. And generally, it's not equal to the asset's cost. Because something like a vehicle, let's say I buy a vehicle, and it's like a Toyota, whatever, and I pay $30,000 for that car, brand new. Generally, cars lose value over time, unless you're talking about something like a collectible Porsche or something like that. Most cars lose value over time. So the fair market value of that vehicle is going to be less. But if it's something like real estate generally goes up in value over time. So real estate will generally be valued more than its cost, more than what I paid for it. Let's say I die and I own a house and a car. The fair market value of the car at the time of my death is probably going to be less than what I paid for it, right? But the fair market value of the house that I bought is probably going to be worth more than what I bought for it, right? In general. But you value the gross estate at the fair market value of the property at the time of the decedent's death, in general. That's how it's done. So it's not generally going to be equal to the asset's cost. The gross estate includes the fair market value of all tangible and intangible property owned partially or outright by the decedent at the time of death. And they mean all property. So tangible property would be something like vehicles, artwork, furniture, jewelry, that sort of thing. That's tangible property. You can touch it. Intangible property would be something like a copyright, a trademark, a franchise right, stock, bonds, Bitcoin, that sort of thing. That's intangible property. Those are intangibles. And that's also included in the value of the decedent's gross estate. Now, what they mean by partially or outright is that, let's say my husband and I own a house together, or we own land together. Partially owned would mean like half of that value would belong to me, and the other half would belong to him. So the value of half of that property would be included in the value of my gross estate. Now, I know that you can't cut a house in half, right? You can't cut a house in half, but any property that I own partially at the time of my death would also be included in the value of my gross estate. And let's say we own a home together and it's worth $500,000 at the time of my death, then $250,000 would be included in my gross estate because I own half of that house and my husband owns the other half. Okay? Life insurance proceeds payable to the estate for policies owned by the decedent payable to the heirs. Now, I want you to understand this conceptually because I know that this is a difficult concept many times for preparers to understand, especially when they're new to this business. And I didn't understand this conceptually either for many years when I was a new accountant, because the whole idea behind life insurance proceeds being valued as part of the gross estate was kind of foreign to me. Okay, let me explain this to you. Life insurance proceeds are never taxable to the recipient. So let's say you buy a life insurance policy. Then you have a beneficiary of that life insurance policy. A beneficiary of a life insurance policy is the one that basically just gets the money of the life insurance when you die. That money is never going to be taxable to the recipient. I want you to understand that. Life insurance proceeds are never taxable to the person that actually gets the life insurance proceeds. However, life insurance is considered an asset of the estate. And if you have a really wealthy person, someone like Bill Gates or Warren Buffett or whatever, their life insurance is an asset of their estate. And the life insurance proceeds payable to the estate, or for policies owned by the decedent payable to the decedent's heirs, are considered an asset of the estate. So if I am a very wealthy person and I own $100 million in assets, and then I die, and I also own a life insurance policy that I paid for, that I own, and let's say it's worth $15 million, then that's considered an asset of the estate, that $15 million life insurance policy. So it's possible that the value of that life insurance policy, when you have a very wealthy person, will be includable in the gross estate and will be subject to estate tax, the value of that life insurance itself. If you have a person who's wealthy and their estate is worth more than the exemption amount. Now, life insurance policies are not necessarily owned by the decedent. Most of the time, when a person purchases life insurance, they purchase it for themselves, and then the beneficiaries of that life insurance are going to be like their spouses or their children. That's what happens most of the time. But sometimes policies are not actually owned by the person whose life is being insured. I know that the whole concept is creepy. At least to me, it's creepy. But you can actually take out a life insurance policy on someone else's life. And the person whose life is insured is not necessarily the policy holder. And a creepy example of this, but a good example of this, is those life insurance policies that you can take out on your kids. And this is the example that I always use because this is the example that helped me understand this concept when I was still trying to figure this out. I feel like this is the best way to kind of understand this. You know, when you have kids, for those of you who have kids, you go into a hospital and you have your kid. And then the hospital like basically sells your name. I'm assuming it's the hospital because all of these companies magically figure out that you've had a kid. You get home with your baby and you start getting like constant junk mail. As soon as I brought home my kids, like I would come home and like a week later, I would be getting so much junk in the mail. They'd be like stuff from Pampers, stuff from Similac, all of these like all of this junk mail would come. And included as part of that junk mail would be like all of these life insurance policies that you can take out on your kid, like Gerber Life. I remember with every single one of my children's births, I have 3 kids. Every time I would come home from the hospital with my baby, I'd be getting all of this junk mail, constant junk mail for weeks afterwards. And I would always get these like flyers to buy whole life insurance for my kid. And at the beginning, I didn't really understand what this was for. But you can actually, as a parent, take out life insurance on your child's life. That would be an example of a policy that would not be owned by the decedent. So I could have my own life insurance policy, then that policy would be owned by the decedent if I were to die, because that would be my life insurance policy. But if I were to take out one of these creepy life insurance policies on my kid's life, then that wouldn't be a policy owned by the decedent because I own the policy, but it's on my kid's life, which I would never do because it's super creepy to me. But that's an example of a policy that's not owned by the decedent. I would be taking out a policy and I would own the policy and I would be paying on the policy, but the policy itself is on my child's life, not on my life. Got it? Okay. So you could potentially have a situation where a policy is not actually owned by the decedent. And if you have life insurance proceeds that are payable to the estate or payable to the heirs or the beneficiaries, then the only type of policy that's going to be included in the gross estate of a decedent is going to be policies that they themselves have purchased on their own lives. Got it? Okay. All right. Then the value of certain annuities or survivor benefits payable to the heirs. So for example, if I owned an annuity or a retirement plan or an IRA or whatever, all of that would also get included in the value of my gross estate. And then the value of certain property that was transferred within 3 years before the decedent's death. And this is kind of called the clawback. These are clawback provisions that are in law. A lot of times when people know that they're going to go, like if people know that they're going to die, they will start gifting property to their heirs, and they will try to do it without the IRS knowing. They won't file gift tax returns because they don't want that property to be valued as part of their gross estate. So the reason why it says certain property that was transferred within 3 years before the decedent's death is that sometimes the IRS will come in, if it is a valuable estate, and look for those kinds of abuses. They'll look for situations where a wealthy person has given away a lot of money to family, friends, that sort of thing, where gift tax returns were not filed, where it was a reportable gift, but it wasn't included on a gift tax return, or it wasn't reported on a gift tax return. And then the IRS will claw it back. They'll say, oh, this gift was not reported, and we're going to include this in the decedent's gross estate. If it's something that it was under the gift limit, like if I gave $15,000 to my brother, then that wouldn't be included. But if I gave $150,000 or $200,000 in cash to my brother, then a gift tax return would have to be filed for that. And the IRS will come in sometimes when it is a valuable estate and say, oh, a gift tax return wasn't filed for this, so we're going to claw this back and include it in the gross estate so that that amount will be subject to estate tax. Okay, that's what they're talking about in this case. The gross estate does not include property owned solely by the decedent's spouse or other individuals. So for example, if I own a rental property with my brother, he owns 50% and I own 50%, then his 50% ownership in that rental property would not be included in my gross estate. Okay, and that goes the same with property that's co-owned by a spouse. So my half would be included, or the value of my half would be included in my gross estate, but his half wouldn't be. Okay. Lifetime gifts that are complete so that no control over the gifts was retained are not included in the decedent's gross estate. In order to qualify as a lifetime gift, the transfer must be complete and irrevocable. So in this case, we're not talking about a situation where it's a gift of a future interest, or a situation where I retain control over the gift, or the decedent retain control over the gift. Deductions from the gross estate. So these are items that are deductible from the value of the gross estate in order to arrive at the taxable estate. Just because you have a person who has a really valuable estate doesn't mean that there's going to be any estate tax. There are situations where a person can have an estate that's valued at $50 million or $100 million, and there's not going to be any estate tax because you get deductions from the gross estate in order to arrive at the taxable estate. You start with the fair market value of all the property that the decedent owned at the time of death. That's the gross estate. So you calculate that first. You come up with the number, and then you take the deductions from the gross estate. So certain deductions, and in special circumstances, reductions to an asset's value are allowed to determine the taxable estate. Deductions from the gross estate may include funeral expenses paid out of the estate. Now, a funeral expense is an expense of the estate. Funeral expenses are not deductible anywhere except on the estate tax return. So that we're talking about the Form 706. Funeral expenses are not the expenses of a living person. Funeral expenses are expenses of an estate because the living person is dead and now the estate has a body that it has to bury. That's why funeral expenses are expenses of an estate. So any funeral expenses that are paid out of the estate are deductible from the gross estate. Administration expenses for the estate, if they're not deducted on the Form 1041. Administration expenses might include court costs, lawyers' fees, accountants' fees to actually file the Form 706, executor fees. All of that would be administration expenses paid out of the estate and also deductible on the Form 706 if the amounts are not deducted on the Form 1041. So they can either be deducted on the Form 706 or the Form 1041, but not in both places. Any debts that were owed by the decedent at the time of death. So let's say you have a situation where you have a property, right? And the fair market value of that property is $500,000 at the time of the decedent's death. That value is included in the gross estate, the value of the property. But if the property is subject to a mortgage, then that debt would be deductible from the gross estate because that's the debt of the estate, right? That's a mortgage on the property. That's a debt that's owed by the estate. So that would be deductible from the value of the property, okay? The marital deduction. This is the value of the property that passes from the estate to a surviving spouse that is a U.S. citizen. So if you have a situation where the decedent is married, obviously the marital deduction is not going to apply if the person is not married when they pass away. Say this is only for people who are married. But if you have a situation where a decedent passes away and the survivor is a U.S. spouse, then all of the assets can pass to that U.S. citizen spouse tax-free. And it doesn't matter what the value of the estate is. There's an unlimited marital transfer if the survivor is a U.S. citizen. The charitable deduction. This is generally the value of property that passes from the estate to qualifying charities. And this is something that generally has to be a provision in the decedent's will. Or, for example, if they had a trust. I could potentially say that I want all of my assets to pass to charity. And if I outline that provision in my will, or for example, in a trust, and I say, okay, upon my death, I want all of my assets to go to my church, then that's the charitable deduction. And if I have basically outlined that in the terms of my will, then I might not have any kind of a taxable estate because the estate is allowed to actually pass assets to a qualifying charity tax-free, 100% tax-free. The state death tax deduction. This is generally any inheritance or estate taxes paid to any state. Some states impose a death tax or an inheritance tax. They will call it different things. The states will have different names for this, but it can be called an inheritance tax, a death tax, estate tax, whatever. States will have different names for this, but any kind of inheritance or a death tax that it's imposed by a state, by the individual state the decedent was living in basically when they passed away, then that's also deductible from the gross estate. And some states impose a death tax and some don't. About half, I think it's 23 or 24 US states have a death tax and the other half do not. So this is going to vary from state to state. But if the state imposes a death tax on the estate of the decedent, then that's deductible from the gross estate as well. The following items are not deductible from the gross estate, and you need to remember this list for the test. Any federal estate taxes paid. So that's not deductible from the gross estate, just the way like federal income taxes are not deductible anywhere. You don't get to deduct federal income taxes on your Form 1040, and if it's an estate, the estate can't deduct these either. Any alimony paid after the taxpayer's death. Alimony, by definition, is money that's paid from one spouse to another spouse or to an ex-spouse. If, for example, I die and I divorce my husband, and there's some provision in our divorce decree that the alimony payments have to continue after my death, then that's not alimony. It doesn't matter what lawyers put into a divorce decree. They will do all kinds of wonky things. If it's alimony that's paid after my death, that's not alimony for estate tax purposes. It doesn't matter what the divorce decree says. Payments of alimony that occur after the payor's death are just treated as distributions to a beneficiary. It's not alimony for estate tax purposes. It's just a distribution to a beneficiary if the estate is continuing to pay any amounts to an ex of the decedent after the decedent passes away. Property taxes are deductible only if they accrue under state law prior to the decedent's death. So property taxes would be a debt of the decedent, but only if they accrued under state law prior to the decedent's death. And this is basically the same rule for taxpayers who are alive. The IRS doesn't allow you to deduct property taxes as a deduction on Schedule A unless you actually own the property in question. So property taxes are deductible only if they are actually your liability in the first place. So that's the same way with an estate. The property taxes are only deductible by the estate on the estate tax return if they accrue under state law prior to the decedent's death, because that would be a debt of the decedent. The marital deduction. Transfers from one spouse to the other spouse are typically tax-free. The marital deduction allows spouses to transfer an unlimited amount of property to one another during their lifetimes or at death without being subject to estate or gift taxes if the receiving spouse is a U.S. citizen. To receive an unlimited marital deduction, the spouse receiving the assets must be a U.S. citizen, and a legal spouse must have outright ownership of the assets. It has to be no strings attached, basically, okay, when the assets transfer to the survivor. The unlimited marital deduction is generally not allowed if the transferee spouse is not a U.S. citizen, and this is true even if the spouse is a legal resident of the United States. This is one of the few areas in U.S. tax law where green card holders are legal U.S. residents. They have a green card, they're legally present in the United States, they have a social security number and the whole 9 yards. But the unlimited marital transfer is not allowed if the transferee spouse, if the surviving spouse is not a U.S. citizen. And this is true even if the spouse is a legal resident of the United States. And I'm going to explain this a little bit more, but the unlimited marital transfer is only permitted if the survivor is a U.S. citizen. Otherwise, it's not unlimited. There's not an unlimited marital transfer. Note that the marital deduction is not the same thing as the deceased spousal unused exclusion or the DSUE. The DSUE is an election that is only available to U.S. citizen spouses. And I'm going to explain this a little bit more, but I want you to realize that the marital deduction and the DSUE are not the same thing. The marital deduction is the assets that are passing through to a U.S. citizen spouse after the death of the other spouse. You get to deduct from the gross estate any assets that actually pass to the survivor. The DSUE is not the same thing as that. Let's talk about the marital deduction and how it works when you have a green card holder and a U.S. citizen. Let's say you have two spouses and they both have very valuable estates. This estate is worth $15 million. This is Amelia, and she is a green card holder. She does not get an unlimited spousal transfer. This is Harold, and he is a U.S. citizen. So yes, he does receive the unlimited marital transfer. So his estate value is 16 million, let's say, and her estate value is 15 million. If she were to die, if Amelia was to die, she's the green card holder in this scenario, okay? If she were to die, she would be able to pass all of her assets to Harold because he's a US citizen. So there would be an unlimited marital transfer from her to him if she were to die. If he were to die, however, he's a US citizen, but she's not, then he would not be able to pass all of his assets to her tax-free. Okay? She could pass all of her assets to him tax-free, but he couldn't pass all of his assets to her tax-free. Now, she could become a US citizen. She could apply to become a US citizen, and then she could potentially receive the unlimited marital transfer then. But if she did not become a US citizen and she remained a green card holder, then he would not be able to pass all of his assets to her tax-free. The marital deduction, the unlimited marital transfer, only applies if the receiving spouse is a US citizen. Okay? But if the decedent spouse was a green card holder or even a non-resident alien, but the transferee spouse, the one that actually receives the assets after the death of the other spouse, if that one is a US citizen, then yes, there would be an unlimited marital transfer in that case. And the estate could escape estate tax, but not the other way around. Okay? So the receiving spouse has to be a US citizen. The transferee spouse. Okay? Let's talk about the DSUE now. The DSUE is the unused portion of the decedent's predeceased spouse's basic exclusion, the amount that was not used to offset gift or estate tax liabilities. A portability election must be made to claim the DSUE on behalf of the surviving spouse's estate. The election can be made automatically by timely completion and filing of Form 706 for the estate of the predeceased spouse. The DSUE is a situation where one spouse dies and then the survivor can choose to transfer the unused portion of the deceased spouse's basic exclusion to themselves. And I'm going to give you an example of how this works so that you can kind of understand it better. But this is a situation where the survivor can choose to basically increase their own exemption amounts for the assets of their estate by transferring the unused amount that was not used by the deceased spouse to themselves. Portability is not automatic. The Form 706 must be filed in order to make the election. And this is true regardless of whether or not the estate is subject to estate tax or is below the exclusion amount. If you want to take the DSUE, if you want to make the portability election, a Form 706 has to be filed. Generally, this is a really good idea to do if a person has even a moderately valuable estate, even if the estate is not subject to estate tax. The executor is the one that's responsible for making this election. Now, generally, if there's a surviving spouse, the surviving spouse is automatically going to be the executor, but that's not always the case. Sometimes the executor and the surviving spouse are different people, and I've seen that on more than one occasion. I have seen a situation where it was two spouses who were both widowed later in life. Their spouses had died, and they were already in their late 60s, and they were friends. They were all friends together while they were alive, and then their spouses died. And the two survivors decided to get married, but they were already in their late 60s. Each one of them wrote out a will and chose executors that were adult children of theirs from their first marriage, right? But they were widowed and they didn't want to be alone, so they got married later in life and were married and happy, but they chose executors that were their adult children from their first marriage in their will, and they actually agreed even before they got married that their assets would pass to their respective children. That's what they wanted. But they were married, and then they both actually passed away as my clients when I was still practicing in California. They both passed away within a year of each other, and the adult children from their respective adult children from their first marriages were the ones who were executors. We ended up filing separate tax returns, one for one spouse and one for the other. And the executor for the husband's estate was an adult son. And for the wife that passed away, the executor for her estate was an adult daughter, both from their first marriages. And that's what they wanted. They put that in their will. So sometimes you will have situations where the executor is not the surviving spouse or not a spouse at all. I've also seen a situation where it was a married couple and they were both elderly. The husband was competent, but he was terminally ill. And then the wife was not terminally ill, but she was incompetent because she had Alzheimer's. So they were still married and they were both in their 80s. The wife was not dying, but she was in a home already and she didn't even recognize her own son. She was incompetent to make her own decisions or manage her own financial affairs. In that case, what ended up happening is they had an adult son that was taking care of everything. The adult son had a durable power of attorney for the mother. And then for the father, the adult son didn't have durable power of attorney for him because the father was still lucid. So the father was still able to make his own decisions and everything else. Even though he was in hospice, he was dying, but he was still competent to manage his own affairs and sign things and everything else like that. So the father wrote out his will with the help of an attorney and named the son as his executor. And then the father actually died first. So the father died first, and the son was his executor, the executor of his estate. And then the son had durable power of attorney for the mother because the mother was still living, but couldn't sign anything or manage any of her own financial affairs. So in that case, the son is the one that's going to be signing everything, not the surviving spouse, even though she's still alive. So the mother was still alive, but she was incompetent. She didn't even really recognize her own son anymore. So he was the one that was managing her financial affairs, but the mother wasn't going to be signing the tax returns as a surviving spouse because she couldn't. When you have a joint return, when it's a situation like that, where one of the spouses is dead and the other spouse is incompetent, then the son, as the executor of the estate, is going to be signing on behalf of his father as an executor, and then signing on behalf of his mother as a conservator. So he's the one that has to manage everything, even though there is a surviving spouse, because the surviving spouse is not competent to do any of this. Okay, so sometimes you will be dealing with a different family member rather than the surviving spouse. And that's especially true if you have a situation like that, where both of the taxpayers are elderly and one of them is either too sick or has Alzheimer's or whatever, and they can't manage the affairs of the estate. It's not an uncommon scenario, all right? In order to make the election to take the DSUE, an estate tax return is required when the first spouse dies, even if no tax is owed. This return is due 9 months after the death of the first spouse. We're talking about the Form 706, which is the estate tax return. A 6-month extension is allowed. The DSUE is not available to non-resident alien spouses. Now, let me give you an example why claiming the DSUE or the portability election is always such a good idea. Gerald and Yasmin are married and both are U.S. citizens. Gerald died on January 30th, 2021, and left a gross estate valued at $19 million. So when he died, he had a very valuable estate and he died at the very beginning of the year. All of his assets were transferred to his wife, Yasmin, who is a U.S. citizen, under his will. So he would get the unlimited marital transfer in that case. Yasmin could inherit all of it without having to pay any estate tax. But then what ends up happening is now, since those assets transferred to her, then now she has $19 million in assets. Do you see how this happens? So none of his estate was taxed because of the unlimited marital deduction, and none of the $11.7 million basic exclusion amount available to Gerald's estate was used because everything passed to her under the unlimited marital transfer. That's the unlimited marital transfer. All of it passes to her and no estate tax was paid by the estate. None of the $11.7 million basic exclusion amount available to Gerald's estate was used, and none had been used to offset gift tax liabilities during his lifetime. Yasmin's accountant files a Form 706 for her late husband's estate and takes the marital deduction and also elects the DSUE. Remember, it has to be a married couple in order to do this. So all of the assets pass to her and there's no estate tax, okay, because the accountant takes the marital deduction and also elects the DSUE. Yasmin then dies later in the same year. She dies on December 20th. So he died at the beginning of the year and she died on December 20th, but they both died in the same year. So Yasmin had not used any of her basic exclusion amount, so Gerald's unused basic exclusion is added to hers for a total exclusion amount of 23.4 million between their two estates. His assets transfer to her, so she has his assets and her assets all added together, okay? And since the accountant was smart and elected the DSUE, now she gets her exclusion plus his exclusion. I mean, they're both dead, so she's not getting anything. But what this ends up translating into is that her basic exclusion amount gets added to his basic exclusion amount, which totals $23.4 million between their two estates, because his exclusion transferred to hers. If Yasmin's estate is valued at less than 23.4 million at the time of her death, the full amount can be excluded and no estate tax will be owed by Yasmin's heirs, which is the whole reason why you want to do this, right? The more assets that you can pass to your heirs tax-free, the better, right? So Gerald died first. All of his assets passed to his wife. If she hadn't claimed the DSUE on the Form 706 or hadn't filed the Form 706 at all, she would have had to because his estate was 19 million. But let's say it was less than the estate tax exclusion amount. Let's say his estate was only worth $5 million and they didn't file the 706 because of that and didn't claim the DSUE. Let's say his assets passed to her, but then added to her assets, presumably she owns assets too, added to her assets, that would be above the estate exclusion amount. And you can't really control when you die. So she died later on in the same year. If she hadn't claimed the DSUE, then she wouldn't have a $23.4 million exclusion. She would only have 11.7. The DSUE allows you to basically take the deceased spouse's exclusion and add it to your own. So her exclusion amount is basically doubled because she took her husband's exclusion, added it to hers, and then when she died, her estate gets an exclusion too. So she can pass $23.4 million of assets to her heirs or her children or whatever tax-free, free of estate tax, which is why the DSUE is such a good thing. Okay, but it's only available to married couples. And accountants sometimes will say that, the way that the U.S. tax law is, there's a lot of marriage penalties in U.S. tax law that are written into the law by Congress for whatever reason. There's a lot of marriage penalties in the law where if you're single, many times you'll get a better tax result, except when you die. So there's a lot of really great tax breaks that you get when you're married when there's a death in the mix. And this is one of them. The DSUE only applies to married couples. So this is a situation where you can elect portability and allow the surviving spouse to basically add the deceased spouse's unused exclusion to their own. And then when the surviving spouse eventually passes away, it's going to happen, right? Nobody can escape death. When the surviving spouse eventually passes away, they get to pass more assets to their heirs or their children because the estate tax exclusion is basically doubled for Yasmin in this case. Okay, so instead of getting 11.7, it's 23.4 because she took her husband's exclusion and added it to hers by electing the DSUE. But the only way that you can elect the DSUE is by filing the Form 706. Has to be filed, even if the estate is under the estate exclusion amounts. The 706 has to be filed in order to take this election. And if it's not filed, then you don't get it. Next example. Anton and Bree are married and have one adult son named Vince. On January 3rd, Anton dies. His gross estate is valued at $8 million on the date of his death. All of Anton's assets passed tax-free to his wife, Bree, who is named the executor of her late husband's estate. Bree doesn't bother to file an estate tax return for Anton's estate because her late husband's estate value is below the exclusion amount. So she doesn't bother to file a Form 706. They tend to be rather pricey because not very many accountants do estate tax returns. So she decided to save a couple $1,000 and not file one. But by default, she can't claim the DSUE unless she files a Form 706. So she doesn't do it. Okay. On December 29th, Bree dies suddenly in a car accident. So she dies in the same year. And she didn't file an estate tax return for her husband, for her late husband. And then she dies later on in the year. The value of her estate is now $13 million because the $8 million presumably added to her assets. Now her estate is worth $13 million. This equals her combined assets as well as those of her late husband. Bree and Anton's only son, Vince, is named as the executor of his late mother's estate. Vince must file an estate tax return for his mother's estate because now her estate is worth $13 million. Since Bree did not file a timely estate tax return to claim the DSUE for her late husband's assets, her estate is now subject to estate tax on the amount that exceeds the exclusion. So she made a mistake. She thought maybe she was going to live forever or whatever, but her husband died at the beginning of the year with a valuable estate. It was less than the estate exemption amount, so she didn't bother to file a Form 706, and she would have been responsible for it because she was named the executor of her late husband's estate. But she didn't do it. And then she died later in the same year, suddenly, and now her son has to deal with this. And the value of her assets, which were her assets along with her husband's assets that she inherited, were valued at $13 million at her death, on the date of her death, which means now not all of her assets are going to pass to their child tax-free. Now her son, Vince, is going to have to file an estate tax return. But if his mother had bothered to do it, if his mother had bothered to file a Form 706 and elect the DSUE, if she had done that for her husband's estate when he died, then all of these assets would have passed to Vince tax-free. But because she didn't do that, then Vince is going to be responsible for filing an estate tax return, and there's going to be estate tax because 13 million is more than 11.7 million, which is the estate tax exemption amount for 2021, which is the year that they died. They both died in the same year. But do you see how this is a much different scenario than the last one? She didn't bother to do it. She didn't bother to elect the DSUE, and her estate was worth 13 million on the date of her death. Maybe her assets went up in value, or maybe she had assets that were worth $4 or $5 million too, and that got added to her husband's assets, which passed to her. But she didn't elect the DSUE, so now her son has to deal with this, and the estate is going to be subject to estate tax. This was a mistake on her part.
This is an extended series continued in the next video. Make sure to subscribe to our channel to get notifications for our tax law updates.